Let us start now with the small quick exercise. SFL Consulting Services opened for business on January 25, 2011. The company maintains the following ledger accounts. They have the cash accounts, they have the accounts receivable, they have the office supplies, the office equipment, they have an account payable, they have the capital stock, retained earnings, consulting revenue, rent expense, and utility expense. What we will do is we will go through a couple of entries and we'll see how we will journalize each of these entries. Let's start first on January 20. The company engaged in the following business activity during the month of January. On January 20, the company issued 5,000 shares of capital stock for 180,000. So, if you remember, issuing 5,000 shares of capital stock, so they are selling 5,000 shares of capital stock. They sold the capital shares for 180,000 dirham. So, they have received 180,000 dirham in terms of cash in exchange for these capital stock. So, receiving cash, it's increasing the cash item. And cash is an asset item. So, we have to increase asset. And since cash is an asset, so the increase in asset will have to be recorded as a debit entry. The capital stock, they have increased the capital stock. They have issued a new 5,000 shares of capital stock. So capital is an owner's equity. It is on the right side of the balance sheet. So this capital stock, being an owner's equity, like liability, it always will be increased by a credit entry. So looking just for this journal entry, it should be a debit cash of 180,000 and a credit of 5,000 shares of capital stock, which is worth 180,000. On January 20, they have paid dirham 1,500 for office rent for the remaining of January. So again, they have paid the office rent. So this is rent expense. And since they have paid for it, so they have paid for it in cash. So cash is reduced by 1,500 in exchange for rent expense. We will see the journal entries on the next slide. I'm just explaining at this moment. On January 21, the company purchased office supplies for $1,000. Sorry, 1,000 dirham. And the payment is not due until February. So now, since we are talking about the month of January in general, now in this exercise, anything that is due in the second month, it is a payment due in the second period, in the second accounting period. So it's an account payable. Office supplies, they have purchased office supplies. So this is an expense. They paid for it 1,000 dirham. But actually the payment will be done in the next month, in February. So it's an account payable that they have to pay later on. On January 22, they purchased office equipment. So again, like office supplies, they bought these office equipment. But instead of using a payment for next month, they prefer to pay for it in cash. So paying for it in cash will reduce the cash account, will reduce the cash balance. And again, I insist on cash. It's very important to know when we are paying the cash. This will reduce the cash available in the company. This will reduce the asset, which is cash. So that entry, when you pay cash, it's a credit cash because you paid the cash. It will reduce the asset. On January 26, they performed consulting services. So since this company is a consulting services company in the first place, so this is the revenue that they are generating. They have revenue to be collected in the value of 7,500 dirham, but they billed the client in February. So the client will not pay them for this service until February. So for them, the revenue is on the credit side, and the amount that they will collect in February, it's an account receivable for the service that they rendered. On January 31st, they recorded a 400 dirham utility expense. Payment due in February. So again, this is utility expense, 400 dirham for the month of January, but they did not pay for it. They will pay for it in February 20. So it's an account payable. Let's look at the journal entry and the description of each one of these entries. So as I said, since they have paid, this is the issue of capital stock. Once they issue the capital stock, they have received cash. So cash is received, so it is registered as a debit, and the capital stock that has increased was registered as a credit to record the issue of 5,000 shares of capital stock. So these descriptions are very important when we get back to this transaction to understand what was behind that transaction. As for the rent, they have paid the rent expense of 1,500 and they paid for it in cash. So we have to reduce the amount of cash, so it is entered as a credit, and the rent expense, it is a debit as an entry. So to record a payment of January rent expense. This is the full description of this transaction. Office supplies. They bought office supplies for $1,000, but they will not pay for it until next month. So this is an account payable that they have to pay in the value of 1,000. Office equipment. They bought office equipment, as we said, and they paid for it cash. So the explanation is to record the purchase of office equipment. So that's the value of 55,000 dirham in office equipment that they will pay for it in the next month. So cash was reduced. Cash is entered as a credit to reduce an asset account. Consulting revenue. They provided the revenue. They have billed the client for consulting services that is actually rendered. So it is earned, but they will not get the money until next month. So it's account receivable in a second period of 7,500. And the revenue is registered at 7,500 as a credit because it's their money. On January 31st, they have bought the utility expenses and it's a liability for them. They have to pay for it. So it is an account payable that will be paid in February in the value of 400 dirham. Now, taking these journal, we have to post each entry in the journal into its proper account. So moving into the posting in the ledger, we have the cash. For the cash, we had more than one operation. We have the 180,000 being the capital stock. We have the 1,500, which is a credit payment for the rent expense. We have the 55,000, which is also a credit because it's for office equipment. So the balance of the cash account, it is the 180 minus 1,500 minus 55,000. So we have a debit balance. On the left side, it's 123,500. The same applies for account receivable. In account receivable, it happens we have only one payment for consulting revenue on January 26 for 7,500. Office supplies. Office supplies, it's a debit. Office supplies, it's for 1,000, and it's this against this office supplies of 1,000. We have the account that will be paid later on. It's an account payable of 1,000. And for the office equipment, we have the purchase of office equipment of 55,000 that corresponds exactly to the cash that we talked about as disbursed because we paid for it. So the accounts payable, we have the 1,000 against the office supplies, and we have in the accounts payable the 400 for utilities expense. So that utilities expense, it's a debit on the utility expense and it's a credit on the accounts payable. Capital stock is 180 that was received in cash. Retained earnings, up to now we have nothing on the retained earnings account. We are still in the process of the business. In consulting revenue, this is revenue due to us, 7,500. It's a credit, but we did not get it yet because it's an account receivable. We have 1,500 that we paid in cash for the rent expense and the utility expense that we have to pay for it for in the coming period. Having all of these accounts, we have to make sure that all the accounts that we have, all the balances that we have in these accounts are posted right. All the figures are posted right. This is what we do in a trial balance to understand if we have posted all the accounts in the correct way. Moving into the trial balance, we have the balance of the cash, 1,300 and 500. We have the balance of the account receivable. We have the balance of the office supplies. We have recorded all the items in the account, just we put them into the two columns available in the trial balance. All debit balances are recorded on the left side, all credit balances are recorded on the right side. Doing this, the addition of all of these, we have in our trial balance a total left side debit balances of 188 and 900 dirham, and the summation of all the credit side. On the credit side, on the right side column, we have also dirham 188,900. So, as we said, this trial balance will only tell us that these two columns of debit and credit are balancing out. So we have no problem at this point in time in the calculation and in the posting of these. But should we have a missing or an omitted or a wrong entry, we need to go through audit to understand each and every transaction.